What was behind today's turnaround? Joining the conversation, Tony Dwyer, Managing Director and Chief Equity Strategist with Collins Stewart, along with Lee Munson, Chief Investment Officer with Portfolio Asset Management. Gentlemen, good to have you on the program. Tony, from the charts as well as the fundamentals there that you're looking at, what do you think was behind the turnaround? Well,
Maria, I think it's just you had a very overbought market. When you look at any of the daily pictures, you know, everything's up kind of in a straight line over the last couple of weeks. And, you know, things like the 14-day stochastic and some of the shorter-term measures you look at are extremely overbought. But in the context of an uptrend, that's okay. It just means you pause, and that's fundamentally what our view is that we're going through this kind of pause in the marketplace. Again, the market's going to correlate to the direction of earnings, which is going to be positive unless the economy goes into recession, which only happens on an inversion of the yield curve, which we're very far away from. So our view is pretty much the same. Try to ignore these day-to-day, you know, pluses and minuses, and stick with an intermediate-term time frame, which is still an uptrend.
All right, still an uptrend, but what if we were to get a double dip? What if we were to see the fortunes in Europe continue to deteriorate given the debt crisis there? Bob Pisani, a word on volume. Do you read much into the fact that it was relatively light today?
Yeah, look, it's been light for the last week and a half, and the volatility index generally has been dropping. Today's an exception here. In theory, there was reasons to buy certain stocks today, but we didn't see it on a particular level. And, Tony, the one point I would make about the earnings, first quarter was great. Second quarter numbers are not going to be quite as great year over year, and I think there's a little bit of concern that the guidance is going to be very conservative for the third quarter. I don't know what you feel, but that's what I'm hearing.
That's definitely true, but at the end of the day, you're still, even if the consensus bottom-up number for 2011 is currently $96, and it's been consistently revised up every quarter. Let's say it's totally wrong, which would go against human nature coming out of a recession, and it's too high. And let's say it's $90. We're still at an 8% earnings yield versus interest rates that are at a very extraordinarily low level. So that, even from a valuation standpoint, if you can weather these storms, unless the curve inverts, earnings are going to be positive. And that's what the market correlates to, the direction of earnings, not the rate of change.
Lee Munson, let me ask you, as a portfolio manager and the guy really directing investments there, how have you changed the portfolio in the last couple of months?
You know, first of all, we decided to stick with some of our higher beta names, and I think we're going to do that between now and the end of the year, between now and the end of the month. I'm really concerned about the key level on the S&P. 1115 was the close December 31st. And so I think that as we closed higher than that on Friday at 1117 on the S&P 500, I think a lot of managers, including myself, you know, start getting some performance anxiety, and they start wanting to chase that going forward into the end of this quarter. So I think if you have some higher beta names, I'm with Tony. I think that you should hold those. I think you should ride them out. But I have some disagreements. I think that starting, I don't think earnings season is going to be that great. I think FedEx showed us a little bit glimpse in what's going to happen. And I think if we have a choppy summer, after the end of this quarter, after the portfolio managers are done window dressing and pushing this market up, Maria, I think people have to look at lower beta names, start bringing down the heat of their portfolio. This summer's going to be choppy. Go for dividends. You know, I like some things like Potash because it's super beaten up in the ag group, and I like AT&T because I can get twice the yield of a 10-year treasury. That'll satisfy me for summer. If not, I think you're trading day to day.
Well, this is an interesting point, Bob, because, you know, we have seen the commodities move and the producers, after being really the winners on the street, turn over a bit, and Lee is recommending potash. I wonder, in terms of the agricultural area and the commodities area, whether or not that trade is still in place, that trade where, you know, it's a China trade where the demand is rising for everything from, you know, agriculture to iron ore and steel.
Yeah, there's one of the few areas. You just hit two of them. Agriculture will definitely do better on what was announced today, and the steel area. But those are pretty small areas, and let me agree with Lee on his point there. FedEx said business was good, but when it came to it, they didn't raise their guidance, and their numbers now are well below analyst consensus for the year, and I think that's what you're going to hear a lot of for the third quarter. At least that is the concern right now.
Well, what about that, Tony? I mean, from a fundamental standpoint, yeah, go ahead.
We had constant revised upward earnings. We had earnings blowing away expectations, and that was right before we saw a 13.5% drop in the S&P 500. So if we're making the case that earnings are going to be a little bit weaker in the guidance, I'll go with that because maybe that's what the 13.5% decline predicted. However, again, you have when the 10-year note yield comes from a 4% to a 3.15 that is very stimulative. It has been, and you still have a steep yield curve. So ultimately, again, I'm not the guy to look at for what the next tick's going to be, but when it comes to an investment time frame, which I think most of your viewers are in the game of, and what I'm in the game of, you want to be able to buy, even if it's very painful and nasty weakness that I frankly didn't expect to be as dramatic. You want to be able to take advantage of that and be in a position to take advantage of that rather than fear it, as long as you have a very steep yield curve in a positive direction.
Well,
in earnings.
You bring up a good point, because what about the fact that the tax structure is going to change? That's another issue that people are talking about. 2011 cap gains tax goes higher, income tax goes higher. Is this going to create selling at year end?
It could, but again, you're at 12 times earnings. Even at $90 for next year, which would be a huge disappointment, you're still at 12 times earnings, which some of that is discounted in a sub 3% core inflation environment. So I totally get it. You're going to get a little bit weaker guidance that comes out of fear of corporate America. But again, I think that's discounted, and the stage is set for what's going to happen 6 to 12 months from now, not what's going to happen next week.
Tony, I'm a big fan of your work. I know you. But listen,
Thank you, Lee.
Don't you think that there's... I do. I like your work. Don't you think, though, I'm a shorter-term trader, but don't you think longer-term there's more natural demand domestically for, say, 10-year treasuries, just as people, you know, who are like in their 50s or 60s running these big endowments that don't want to see another huge 40% drop on their watch? Don't you think that there's a little bit more to the treasuries than just simply the government saying, hey, listen, at low rates you have to buy stock?
Don't you think they're already in treasuries? There are massive amounts of people in treasuries already. There's argument at the opposite end. There's too many people in treasuries.
Well, the move to treasuries correlates very well, as Lee knows. What happens is the treasury yield correlates directly, most directly, with a core level of inflation. So unless you're in a deflationary environment, the current correlation is very high, and it should be. We should be around where we are. But again, with a steep yield curve and a 0% Fed policy, monetary stimulus in the U.S., and in Europe, and maybe even in Asia as they come off their restrictive policy, you're in a situation where you could expand.
Guys, thanks so much. We'll keep watching this story as it develops, and we know it will develop. Gentlemen, we'll see you a little later. Thanks so much.